This week could tell us more about the AI build-out than the last 6 months combined, and someone is about to get badly wrong-footed. Welcome back to Wealth Signal. Today we're settling one big question before this earnings week even gets going. This content is for educational and informational purposes only. Nothing in this video constitutes financial, investment, legal, or tax advice. Always do your own research and consult a qualified professional before making any investment decisions. Investing involves risk, including the possible loss of principal. Here's the obvious answer most people would give you. Memory stocks are the risky ones this week. Micron, SK Hynix, Seagate, volatile, cyclical, everybody already knows that. But I don't think that's actually where the danger is sitting. I think the real risk this week is sitting with the biggest, safest-looking names in the entire market. Microsoft, Meta, Apple, Amazon. Because this is genuinely one of the most loaded weeks of 2026 for anyone following the AI infrastructure build-out. We've got memory earnings from Seagate and SK Hynix. We've got all 4 of the big hyperscalers reporting. We've got the picks and shovels names like Vertiv and Lam Research, compute players like ARM and Qualcomm, packaging names like ASE, and a whole stack of memory and equipment names: Silicon Motion, FormFactor, Corning, Modine. That's basically every single layer of the AI stack reporting inside the same 5 days, which means by Friday, we're going to know a lot more about where 2026 is really heading. If you want breakdowns like this before the moves happen, not after, hit subscribe now. It genuinely helps this channel keep growing. Today I want to walk through why I think the hyperscalers carry more near-term risk than the memory sector. Break down a fascinating read on why this AI build-out isn't actually overbuilt, tell you exactly what to watch for in Microsoft, Meta, Apple, and Amazon's earnings, and finish with a pricing reality check on Chinese memory that didn't go the way most people expected. Let's start with the reason I think hyperscalers are more exposed right now. Look at what happened to Google last week. Its stock opened around $356 a share, and by the time the week closed, it was sitting near $319. Roughly a $20 a share hit, tied almost entirely to the reaction after earnings, even though the actual quarter itself was strong. What actually spooked the market wasn't the numbers Google reported, it was CapEx. Google posted negative free cash flow for the first time in the company's history because of how much it's pouring into data centers, with guidance now pointing toward $205 billion in spend this year, and signals of even more aggressive spending into 2027. The market saw that free cash flow flip negative, saw the raised CapEx, and got nervous, even with strong underlying earnings. And that's exactly what worries me heading into this week, because Meta, Microsoft, Apple, and Amazon all report in the next few days, and I think they're all about to signal something similar: bigger CapEx, not smaller. Why? Because reports point to combined hyperscaler CapEx targets exceeding $1 trillion in 2027. Nobody wants to be the one who slows down and looks like they're falling behind in this race. If they pull back even slightly, the market could read it as weakness. If they lean in harder, the market could read it as reckless spending. Either way, that's a much tighter needle to thread than what the memory and hardware names have to deal with this week. Drop a comment and tell me, do you think the hyperscalers carry more risk this week, or the memory and hardware names? I want to see where the community actually lands on this. Now here's where it gets interesting, because I came across an article this week that I think reframes this whole debate. It's from investing.com, and the core argument is basically this: this AI build-out isn't overbuilt, it's becoming a genuine asset class. The article breaks the AI economy into 3 layers, and the first one is the hardware layer, framed as a generational transfer of free cash flow, moving straight from the hyperscalers into the hands of the hardware and memory companies building the infrastructure.
Combined 2026 hyperscaler capex has reportedly reached $725 billion, up 77% from $410 billion in 2025, and that's expected to blow past $1 trillion in 2027. And one level down, that spending is already showing up as real profitability across the hardware layer. Memory pricing is reportedly up a cumulative 435%, and Micron's gross margins are said to be nearing 86%. Compute spend alone is around $380 billion this year, roughly double 2025, and it's expanding well beyond NVIDIA. Intel's data center revenue reportedly grew 59%, its best pace in 15 years. Texas Instruments' data center sales are set to more than double, past $3 billion. This isn't a one-company story anymore. It's spreading across the whole hardware ecosystem. The second part of the article tackles the bear case head-on, the idea that once hyperscalers like Meta and Tesla start renting out spare compute, that proves there's a glut and the whole AI trade is over. The counterargument is built purely on the economics. 1 gigawatt of compute reportedly costs around $30 billion to build. At a conservative rental rate, that generates roughly $20 billion in revenue, an 85% operating margin, about $17 billion in operating income, and around $14.5 billion in net income a year, a payback period of a little over 2 years. Apply that to Meta specifically. They reportedly sit on 7 gigawatts of compute, doubling to 14, using an estimated 60 to 70% of it. If they monetize even 5 gigawatts of excess capacity, that could add roughly $70 billion of income. That's not a company drowning in unused chips. That's a company sitting on an asset it can rent out twice. There's also a pushback here on the depreciation fear, the idea that GPUs become worthless within a few years. The article points out that 4-year-old GPUs are reportedly still commanding rising rental rates in the resale market, which doesn't support the worth 0 in 5 years assumption a lot of bears have been running with.
On the demand side, the article cites more than $2 trillion in backlog sitting across the 4 major cloud providers. Alphabet's own cloud business is highlighted as the cleanest example, reportedly growing 82%, with a 36% margin and a $514 billion backlog, and still short on capacity, even after guiding capex up to $200 billion. And this is where Anthropic enters the story. The article notes Anthropic has contracted more than 11 gigawatts of compute across major deals with partners including Amazon, Google, Broadcom, AMD, Microsoft, and NVIDIA. For the hyperscalers, renting compute out to labs like this isn't described as a sign of oversupply. It's framed as a second monetization engine coming online. Then there's the piece the article says could flip the entire market narrative. The idea that a frontier AI lab could actually turn profitable. The claim is that Anthropic's revenue run rate went from around $9 billion at the end of 2025 to more than $47 billion by the middle of 2026, driven by inference costs falling roughly 40 times since 2024, while revenue per token has fallen only about 9 times over the same period. At that combination loss of $555 million to an estimated profit of over $1 billion by the third quarter of 2026. If that holds up, the article's bottom line is simple. The hardware layer offers the cleanest risk-reward in this entire sector, as free cash flow keeps shifting from the buyers of compute to the suppliers of it. Before we move on, everything I've referenced visually in this video is saved as a downloadable summary file in our Wealth Signal Telegram channel, along with every past and future videos file. Links in the description. Go grab it. If breakdowns like this are useful to you, Tapping like genuinely helps more people find this video. So with all of that context, here's exactly what I'm watching in each of the big four this week. Starting with Microsoft. Azure volume growth. Is that acceleration actually holding? Infrastructure spend and data center revenue. And crucially, any commentary on supply tightness or inventory normalization. Meta. Their Reality Labs update. The hardware roadmap and memory content per device. AI compute spend and infrastructure investment. Ad revenue as always. And their CapEx outlook. Apple. And this is the one I think matters most for the memory sector specifically. iPhone shipment and unit growth, whether that's supporting DRAM and NAD demand, services revenue, AI feature rollout, and inventory levels. There are also rumors circulating about a possible partnership with Prism, a company claiming it can compress memory, and separate rumors that Apple could look to buy memory from CXMT if regulators allow it. If either of those surfaces, it could be the single most pivotal signal for the memory sector all week. Amazon. AWS revenue growth, CapEx and infrastructure spend, supply chain commentary, and memory availability and lead times. Bull case for memory this week. Infrastructure spend staying elevated, supply constraints holding, and pricing staying firm across DRAM and NAND, plus any signals of new long-term contracts with the hyperscalers. Bear case. CapEx slowing down, demand softening, inventory building up, or HBM supply improving faster than demand can absorb it. The part I think is genuinely actionable. If the hyperscalers do take a hit this week the way Google just did, that pressure could open up a real entry point, because these are still foundational businesses to the U.S. economy. Microsoft is trading around $381, with an average analyst price target near $555. Meta moved between roughly $594 and $644 through the week, with an average price target near $822 across 71 ratings, all rated buy. Amazon is trading near $231, with an average price target around $317 across 69 ratings. Apple is the outlier. It actually had a positive week, trading around $333, already sitting above its average analyst target of roughly $321.85. So if Microsoft, Meta, or Amazon get pushed lower this week the way Google did, that gap between price and target could turn into a legitimate opportunity, not a reason to panic. One more signal before we wrap up, because a lot of people have been expecting Chinese memory to undercut the market on price. There's a piece on Tom's Hardware looking at CXMT-based DRAM modules actually hitting the market now, and the pricing doesn't look like the bargain many expected. Comparing a 64GB DDR5 module built on Samsung and SK Hynix chips against the CXMT equivalent, the article puts the difference at around $60, which it frames as roughly a 2.2% gap, basically negligible at these price points. On top of that, CXMT is reportedly using older fabrication technology, which means higher power consumption, lower performance ceilings, and weaker overclocking headroom compared to the big three. So the fear that Chinese memory floods the market and crashes pricing? At least based on what we're seeing right now, that's not what's actually happening. Pulling it all together, I think the hyperscalers carry the sharper near-term risk this week, because they're the ones walking the tightrope on CapEx guidance. But the hardware and memory layer, the actual builders, keeps looking like the stronger structural position, backed by real pricing power, real margins, and real demand that isn't showing up as a glut. If you found this useful, share it with someone trying to make sense of this earnings week. And if you want the visual summary file for this video, join the Wealth Signal Telegram channel. Link is in the description. I'm Alex Carter, and I'll see you in the next one.